Good morning and welcome to Staying Ahead of the Curve. My name is Jeff Snyder, Vice President and Senior Consultant with Camac Retirement. We're coming to you live from Washington, D.C. today at the Defined Contribution Institutional Investment Association's Public Policy Forum. So we've got some great guests, and joining me now is Brad Case. He is an economist with the National Association of Real Estate Investment Trusts. Brad, thanks for joining us on the show today.
Jeff, it's good to be with you.
So I want to get into REITs, I want to get into listed, unlisted real estate, but let's talk about the market. We've had some volatility. We've had volatility in general for the last year or so, but I want to get your assessment of what's going on in the market, and we'll go from there.
Yeah, honestly, volatility is actually, people talk about volatility, but you look at the market and it's not actually as volatile as it sounds when people are talking about it. Volatility for real estate that's traded through the stock market is actually a little bit less than volatility of non-real estate companies, adjusting for the size, because generally speaking, smaller companies are going to be more volatile than larger companies, the largest companies in the market. But volatility really isn't that big a deal right now for investors, although there's a lot of discussion about it because there's a lot of uncertainty about what's going to happen with macroeconomic conditions and what's going to happen with interest rates. People, when they're uncertain about something, they generally expect to see volatility. We're not actually seeing that much volatility.
So in terms of interest rates, we've had an interest rate increase this year. We may get up to 2 or 3 more. You're a former representative of the Washington Federal Reserve Board. Perspective on what you're seeing in the market in terms of interest rates and what that means to you.
Yeah, the Federal Reserve Board has been trying to stimulate economic growth over the past several years by holding interest rates down. And what they're saying is the economy is improving so that it can sustain its own growth. It doesn't need us to be artificially holding interest rates down. So it's not that they're jacking up interest rates to try to temper the economy. What they're saying is we don't have to be providing so much stimulus to the economy. So investors really should think about this as a reflection of a good situation in the macroeconomic fundamental conditions in the country. For real estate investors, as the macroeconomy continues to strengthen, we can expect to see increases in occupancy rates, increases in rent growth, increases in the net operating income that properties are producing, which helps investors both in terms of the income that gets distributed to them and in terms of the value of the properties and the value of their investments in those properties. So this really is good news, and there is a general sense that, yeah, we'd like to see interest rates stay down. The only way interest rates will stay down is if the macroeconomic growth sputters, and I don't expect that. But investors should really try to move away from the idea that lower interest rates are good. Lower interest rates reflect weakness in the economy, and equity investors, including real estate investors, want strength in the economy.
Well, it's really about that long term. I mean, this is a group that's focused on retirement. Retirement is a long-term prospect, and so you have to take that long-term and global approach when you're looking at retirement.
And I would even go farther than that. You don't want to be in a situation where just anybody can make money because interest rates are so low. You really want to be in a situation where if you are a good investor or a good investment manager, you will be making money. And as interest rates go up, debt isn't available to just anybody with a stupid idea. Debt is available to people who have good ideas. So an environment with better economic growth and higher interest rates, they go together, is typically a better environment for investors.
So last year we interviewed Michael Gruppe about REITs, and would like to get your assessment. Your organization, National Association of Real Estate Investment Trusts, really represents the REIT managers and REITs in general. So I'm wondering, it's almost April 2017. We talked to Michael last year. Can you just kind of paint a picture about real estate? You already talked a little bit about real estate, but real estate investment trusts and the how they react to interest rate increases.
Yeah, it's interesting. We're in this situation where if you look at the real estate market generally, it's very strong. And on the private side of the real estate market, not REITs, I should say, REITs are, many REITs are traded on stock exchanges. We call that public real estate. Other REITs are not traded on stock exchanges, and that's generally what we mean when we talk about private real estate, as well as non-REITs. The private side of the real estate market has been very strong. And the Federal Reserve has actually been concerned about prices being too high in that part of the market. When you look at REITs, it's kind of the opposite situation. REITs have not benefited because of this concern that investors have about interest rates. Typically, when interest rates go up, REIT investors benefit, and that's certainly what I expect over the next few years. But in the broader market, we haven't seen that yet. So if you look at valuation metrics, what they suggest is that REITs are very attractively valued, and investors can generally expect to see really very strong returns going forward when REITs are at that kind of valuation level. And that's true whether you look at the stock prices of REITs relative to the values of the companies that they own. REIT stocks are at a discount relative to the portfolios that they own, which is a very bullish signal for investors. When you look at dividend yields, how much they are, the spread between dividend yields of REITs and other investments like treasury bonds or corporate bonds, again, a very bullish signal. So REIT investors are in this situation where they haven't been rewarded as much as they should be over the last few years for the strength in the real estate market. But it's really a good entry point for anyone who's thinking about making either investments or REITs or additional investments in REITs.
So one of the issues that we deal with in the retirement industry in the defined contribution space is the difference between direct public and private real estate versus real estate investment trusts. And today, there are a few manufacturers, product manufacturers, that actually have a product that can fit within a DC construct. Mm-hmm. But how do you resolve that between a REIT and a pure direct real estate investment? They're very different in terms of how they operate and how they work.
I would say they're not really that different. The real difference between the liquid part of the real estate market, which is REITs on stock exchanges, and the illiquid part, is that it takes a long time for information from the illiquid part of the market to be revealed. So if something affects the value of properties, let's say something affects the value of office buildings, that will show up right away in the stock prices of REITs that own office buildings and are traded on stock exchanges. The same information will also show up on the private side of the market, but it'll take 6 months to a year or even a year and a half, depending on how that information is going to be collected on the private side. So if you're investing in the private side of the market, you really need to be paying attention to what's happening to REITs, because you can pretty much plan on that showing up in your numbers a year or so later. So one of the ways that you make money if you're running a REIT is to take advantage of the relationship between the public and private sides of the real estate market, sell properties to the private side when those properties are overvalued, which is, I think, the current situation, and buy properties from the private side when they're undervalued. So that's sort of an ongoing value creation strategy for people who run REITs.
And it's certainly something that plan sponsors of retirement plans, if they're considering the various circumstances, need to really think about and understand how they fit into their retirement plan, whether it's a defined benefit plan or a defined contribution plan.
Yeah, absolutely.
Brad, thank you so much for joining us on the show today. We certainly appreciate your update.
Oh, it's my pleasure.